Friends, I, Captain Vivek Jain, welcome you all to my 12th episode. If you have seen my earlier videos, we have so far discussed balance sheet, profit and loss account, and some of the financial ratios. Ratios that we did discuss in the previous video related to investment valuations. Specifically, I explained earnings per share, price earnings ratio, book value, which is like net asset value, and price to book value ratio, which is called PB ratio. Friends, today we shall discuss some of the remaining ones. So friends, we start a presentation. Dividend yield, let us first understand it. A stock's dividend yield is expressed as an annual percentage of the prevailing share price and is calculated as follows. Dividend yield in percentage equals annual cash dividend per share divided by the current price of the stock multiplied by 100. An simple example is given here. If the annual cash dividend of a share is 10 rupees and the price of the stock in the share market is 500 rupees, then the percentage works out to 2%. 1 to 2% up to 3% is the normal dividend yield that one can expect from a good company's share at the prevailing market price. A good growing company earning good profits and market rewarding it with reasonable good capital appreciation also should pay a reasonable amount of dividend to its shareholders. Like I said just now, on an average, it has been observed that such companies which are darling of the investors, so to speak, declare and pay dividends regularly with an annual yield of between 1 to 2% or maybe up to 3%. This may appear quite low, but you have to add this to the capital appreciation. A good share for long term after a period of time will appreciate in market value. And if the company continues to reward the shareholders with a dividend yield of even 2% or so of the prevailing market price, which normally is the policy of most of the board of directors of the company, more or less, then after a good length of period, that dividend, the dividend in future will translate into much higher yield when it is compared with the original purchase price. I will give you another example over here. Let's try and understand, please. Let us say I bought a share in the year 2010 for 100 rupees each. In 2010, I received a dividend of 2 rupees per share only, which worked out at that time 2% yield. Now in 10 years till the present year 2020, let us assume the share price appreciated at 18% per annum compounded. So accordingly in 2020, we can expect the share price to be 500 rupees. Now, like I also said that if the company maintains its policy, profitability is also there and continues 2% yield on a current market price, then one can expect a dividend of 10 rupees in the year 2020. That means from 2010 and 2020, the 2 rupees dividend of 2010 kept on increasing every year till in the year 2020 it becomes rupees 10. Now this dividend of 10 rupees works out to a yield of 10% if we compare it with the original purchase price of 100 rupees, which was in the year 2010. That means the dividend yield initially it may be 2%, but if you keep the share for a long term, as we have shown in the example for 10 years, that 2% keeps increasing gradually till in 10 years it can come up to 10%, more or less. plus the capital appreciation is also there, as we have taken over here 18% per annum compounded. Friends, holding good company shares for long term has that distinct advantage. Let us now discuss gross profit margin and net profit margin. Basically, it is the amount of profit at the gross level or maybe at the net income level, as the case may be, generated by the company as a percent of the sales generated. The objective is to detect consistency or rising or falling trends in a company's earnings. If the sale is 1000 crores and if the company earns 100 crores gross profit margin at the gross profit level, then it works out 10%. And if that 100 crore becomes, let's say, 60 crores after removing all the mandatory expenses, then the net profit becomes 60 crores, which works out to 6%. So this is a small example I had given you. A rising profit margin translates into positive investment quality. And to a large degree, it is the quality and growth of a company's earnings that drives its stock value in the market. As I've shown in the example here, net profit margin is equal to net profit divided by sales multiplied by 100. So if the net profit is 200 crores and the sales are 2000 crores, then the net profit margin works out to 10%. Gross profit margin must have been definitely more than this. We now come to return on assets, as we also call it ROA. This ratio indicates how profitable a company is relative to its total assets. The return on assets ratio illustrates how well management is employing the company's total assets to make a profit. The higher the return, the more efficient management is in utilizing its asset base. And this ROA ratio is calculated by comparing net income to the average total assets. As we have shown in the example here, ROA in percentage is equal to net profit divided by average total assets multiplied by 100. We have taken, let's say, 200 crores net profit, works out at average total assets being 1000 crore, 20%. Next ratio is more or less little different, return on equity, ROE. This ratio indicates how profitable a company is by comparing its net income to its average shareholders' equity. Shareholders' equity, as you must be knowing, is the total share capital which has been issued so far, plus the accumulated reserves which has probably been kept in the reserves column by the company. As we have discussed earlier, the dividend is never given in full. A part dividend is kept for reinvestment. The return on equity ratio measures how much the shareholders earned for the investment in the company. The higher the ratio percentage, the more efficient management is in utilizing its equity base, and the better return is to investors. As the formula, ROE in percentage is net income divided by shareholders' equity multiplied by 100. And as I said, shareholders' equity means issued equity capital plus the accumulated reserves. As we have taken an example here, the net income being same 200 crores, whereas the equity capital issued plus accumulated reserves may be 1200 crores. So this will work out to an ROE of 16.7%. ROCE, return on capital employed. This is also expressed as a percentage, and it complements the ROE ratio by adding the company's debt liabilities. That means funded debt is added onto the total shareholders' equity, which reflects the total capital employed by the company. This measure narrows the focus to gain a better understanding of a company's ability to generate returns from its available capital base. By comparing net income to the sum of a company's debt and equity capital, investors can get a clear picture of how the use of loan leverage impacts the company's profitability. Definitely, the profitability should be better because we have enhanced our equity capital, shareholders' equity capital, by also obtaining some loan. Financial analysts consider the ROCE measurement to be a more comprehensive profitability indicator because it gauges management's ability to generate earnings from a company's total pool of capital. Formula ROCE in percentage is net income divided by capital employed multiplied by 100, and capital employed is debt that the company has taken, which is a liability, plus the shareholders' equity. And as you know, shareholders' equity means total share capital issued so far plus the accumulated reserves. So example is ROCE, net income we have assumed as 250 crores and 1400 crores being the debt liabilities plus shareholders' equity, it works out to 17.9%. Friends, we now come to debt equity ratio. Let me tell you, this debt equity ratio, or it is also called DE ratio, is very important and indicative because it compares a total company's debt, total liabilities in terms of debt, to its total shareholders' equity. This is a measurement of how much suppliers, lenders, creditors, banks, financial institutions, they have committed to the company versus what the shareholders have committed. And the commitment of all these financial institutions also depends on what is the shareholders' equity capital of the company. Debt equity ratio, there are guidelines by the government under the Companies Act, depending upon the industry, where a company cannot exceed its debt equity ratio. To a large degree, debt equity ratio provides a good indication of a company's leverage position, as I said earlier, because it compares the total liabilities to shareholders' equity. A lower ratio means that a company is using less leverage and has a stronger equity position and less outflow of interests on loans. Formula is debt equity ratio is total liabilities or loans, as we may call it, divided by total shareholders' equity. As we have taken an example here, if the total shareholders' equity is 1200 crores and the liabilities or loans taken, the debt taken by the company amounts 600 crores, then debt equity ratio is 0.5. I might just inform you that there are many debt-free companies and there are many companies, depending upon the industry, where debt has to be taken for working capital and for many other requirements. Normally, by and large, which we will of course discuss in the future episode also, many analysts believe that a debt equity ratio normally should not exceed 1:1. For example, if the shareholders' equity is 1000 crores, which includes total capital issued plus the accumulated reserves, then the debt should not increase 1000 crores. That is called 1:1. It should be less than 1000 crores. Only for certain industries like banking industry or non-banking financial companies, certain industries allowed by the government, the debt equity ratio may be increased, allowed by them, up to 2:1, sometimes 3:1. We will again talk about the debt equity ratio of different industries later on. Now we spoke about interest outflow. If the debt is less, the interest outflow is less. So interest outflow regarding that, it will be good to mention interest coverage ratio briefly. The interest coverage ratio is used to determine how easily a company can pay interest expenses on the outstanding debt. The example of interest cover we are giving here, this ratio is calculated by dividing a company's earnings before interest and taxes, as it is called EBIT. More or less gross earnings, you can say, by the company's interest expenses for the same period. The higher the ratio, the better it is. Interest coverage ratio, I'm repeating, is equal to EBIT divided by interest. And the example shown here is, if 300 crore is the gross earning of the company, that is earnings before interest and taxes, and the interest has to be paid 60 crore rupees, depending on the loan that has been taken so far. So the ratio works out to 5. That means the company has got 5 times gross earning than the interest that the company has to pay. So the higher the ratio, the better it shows the strength of the company. And here also the guideline normally is that it should not be less than 1. In fact, 2 or 3 is what most of the analysts would prefer, at least. But 1, if it is less than 1, then it becomes very difficult for the company, may become difficult for the company to keep paying that interest in the coming years. Friends, we shall discuss and understand some more important ratios which will show the quality of a company's financial strength in our forthcoming episodes. Till then, please do study the financials of few companies and practically verify the ratios that we have discussed today. Because a good familiarization with various ratios will be necessary for comparative study between various companies, and also for comprehension of financial strengths and weaknesses of any particular company. Once you get acclimatized and familiarized with various ratios, you yourself will be able to gauge the quality of the company to a large extent. Friends, if you have found this discussion knowledgeable and interesting, please subscribe to the channel in case you have not done so that you will be getting all my episodes, past and the future ones, in good time on your screen. Please write your comments in the box provided, and queries, if any. I shall try and reply to all of them. See you again, friends. Have a nice day.